in cash from the corporate tenant in payment of rent for a 3-month period, October, November, December. And at October 31st, after 1 month is expired, we have to think about what the adjusting entry is going to be. Now, the adjusting entry is going to be a debit to the unearned revenue and a credit to the rent revenue. Now, in this case, and I know I asked a question and someone helped me with that, what's the original entry? Well, the original entry was going to be a debit to cash. This was on October 1. Debit to cash and a credit to unearned rent revenue. So that was the original entry. And you need to know how the transaction was recorded first in order to make the adjustment. So if I would have debited cash and credited rent revenue, then you'd have a totally different adjustment. So in this case, we know that 1/3 has been earned at this point, and therefore 3,000 is going to be removed from the liability and recorded as a revenue. And the good thing about this approach is that, again, adjusting entries will always have one balance sheet, one income statement account affected, and no cash, as I said. Now, when you look at the adjusting entry, the original entry on October 1 was a debit to cash, credit the unearned revenue, but then when we post this, debit the unearned revenue, credit rent revenue. The rent revenue will be closed out, as we'll see later on today. But the bottom line is, to do a logic check in your mind and say, well, look, I've got 1 month earned, that's 3,000, and I've got 2 months unearned, which is 6. So just be sure that the numbers make sense. And as I said before, it always has to balance out. And I think I've also illustrated this to you as well. So if you had a $9,000 cash collection, at some point when you check it, you started out at 9, you got 6 now, so the other 3 is earned. So therefore, it always has to balance. The sum of the revenue recognized and the liability has to be 9,000. Okay, so you always will have the 9,000 as the balance in this case, or whatever the collection was. All right, so that's where we left off. Questions on the unearned revenues. Again, I am going to ask questions. Everyone's going to have a chance, I guess, to get called on at some point, but someone already helped me with this, so we're good to go. Questions on deferred revenues? Any questions on deferred?
Multiple choice question, A, B, C, D, maybe use. It's like
All right, so as always, we've got questions, and again, the clickers, these are designed to, first of all, help me understand where you are and help me understand where I need to be to try to get you up to speed if something is not clear. So let's go through some of these questions. All right, first, we'll go over together, and that is unearned revenues may initially be recorded as liabilities or revenues, and the answer is true. So if I was asking you an essay question, I'd ask you to explain that to me, and it really doesn't matter how it's recognized throughout the year. What does matter is what is adjusted at the end of the period. So you have to make sure that the accounts are correctly stated at the end of the accounting period, the end of the accounting period. Okay. All right. Here's an interesting question, number 2. Let me read it to you first, and I'm going to ask you to answer it. If an unearned revenue is initially recorded as a liability, as it is recorded here, the adjusting entry will record the unexpired portion. This is a wording question, so let's go through this, and I should have this set up as a 1 minute on a timer. Okay, So it's false, and that's the correct answer. Well, let's see why. Anyone want to help me with this? I can call on you, but, yeah, Patriot.
It's basically just the word unexpired. It should be expired.
Yep, or it should be, well, unexpired, that's correct, that the word unexpired is wrong. What is it really recorded? I think what you want to do, yeah, is that it?
It's recorded, like on the unearned rent revenue, it was recorded in 3,000 will be used up.
Right, or what was earned, actually,
Yeah.
what was earned, yeah. So it's not the unexpired portion, it records the portion that's earned, The unexpired, from the standpoint of the expense side, that's why it's wrong also. To make this more correct, this probably should have said unearned portion. So that was good, so you picked up on that, that's great. All right, so now, let's do, number one, multiple choice. And I will give you, let's see, I'll move this out of the way. That right there. So let's see if we can get it up a little further. No, I can't, so I will, in case you don't have the notes with you. All right, so let's go ahead and I will give you, move this over, an extra minute. Let's see what we got. That moves out of the way. All right, so, yeah, the answer would be C. And let's see, you can help me. Richard, could you help explain that one to me? How you got, if you got C?
See, well, you divide 6 months from the 7,200. Basically, the rent is 1,200 per month.
Okay, so you divide 6 into the total?
Right, and you get utilize 2 months of the rent, then you would debit on the rent at 2,400 credit.
Right.
The rent revenue 2,400.
Right, yeah, so you've got basically what you can do, and we'll just change this. All right, so, let me say I work these out myself. So what you'd have is 7,200 prepaid over a 6-month period, creates 1,200 per month. The rent goes from July to August, it's all July and August, it's 2 months. 2 months times 1,200 is the 2,400 earned. Then the next question is, how was it originally recorded? It tells you that it's originally recorded as a liability, so therefore you have to debit the unearned and credit the rent revenue. So C is the correct answer on that. Anyone have any questions? Yeah, Z?
Wait, it said it was reported as revenue?
Yeah.
Oh, it does say that.
It's
Oh,
about
I'm sorry.
that, too.
Ah, it's an honor. Oh, yeah, okay, so that's good. So we're gonna change that then. But it's an honor. All right, so if it was recorded as a revenue, let's go, all right. So now what you'd have to do is reduce the revenue and increase the unearned. So it's gotta be B then in that case, right?
B.
Yeah.
B.
B, yeah, so what will happen, thank you. I just picked it up as unearned. So if we have unearned, okay, and we have the revenue. Okay, so this one was originally recorded as revenue, so that the amount earned has to be 24. So therefore, this has to be 48. So that has to be B. Yep, so it is B.
Like, how can it be originally reported as revenue? Because isn't it not earned until time goes by?
Right, but that's the purpose of the adjusting entry.
Okay.
That's the purpose. So, yeah, so I actually read that one quick. I just, again, made the same mistake that somebody did. So, it is revenue first, which is not wrong, but you have to correct it. So the answer has to be, at some point, that the rent earned has to be 2,400. So it has to be for the 2,400 for the 2 months, and the balance is for the 48. Which is the 4 months that remains. It's a 6-month period. So basically, it is a 2 months here and 4 months here. But that's a good question, Chris, on the idea that if you record it first, is it wrong? Yeah, technically it's wrong, but as long as you correct it before the statements are issued, you're okay. All right, good. So that would be for number 1. Any other questions on that?
I'm a little lost, because at first I thought it was D because of the 2 months. So
Yeah,
I'm
but
not
the,
sure how you go about it.
Yeah, but what happens here is if you put 7,200 into a revenue account and only 2,400 is earned, then 48 has to be deducted from the revenue. And then the rest of that becomes the liability. So that here, if you took D, you would have reduced the revenue, but only for 2 months. You gotta reduce the revenue for 4 months, which is still unearned. So it's just a matter of making sure that when you're done, you've got 2 months earned and 4 months earned. 2 months earned, 4 months earned. Good. All right, good. So, yeah, so you're just gonna make sure that we have the proper amounts. As I said, it's gotta add up to 72. It's gotta add up to 72. Yeah.
So the original entry would be debit cash for the 7,200 and credit on earned revenue, right?
Yeah, well, you would expect it to be credited to unearned revenue, as I was. I got fooled myself. But in this case, they credited revenue. So the original entry here was to, what this means is that on the original entry, move that over, this one said you have cash, 72, and revenue, 72. That was the original entry. And as Chris was saying as well, you expect, and I expected to see that go into unearned. All right, good questions. All right, so anything else? We'll go to one more. All right, so that was the original entry. Let's try the next one. And, all right, so in this case now, this was credited to unearned revenue. So let's do number 2. So let's make sure, I'm gonna make sure I got this one correct. So we've got on January 1, Thunderball Hockey Association sold 300 season passes. That's an advance collection of $200 each. So you collected $60,000 in advance. Season lasts for 4 months, February through May, and it's credited to unearned revenue. So this time it was debit cash credited to unearned revenue. And we want to know what is the 1 month entry that you would make to earn the revenue. All right, so most of us said C on that one. Let's see if we can get someone to help me. Jason here? Silva, Jason, what about Morris?
Well, pretty much it's February through May.
Right, February through May,
So February, March, April, May, 4 months. And
4 months.
200 times 300, and then I divided it by 4 months, and then we'll start it.
Okay, yep. So it is up on the screen. So you collected, let me show you calculations. So you collected, if you look up on top of the screen, you collected $660,000 in advance, correct? You had $200 per ticket. The season tickets are $300 each. Then we know that the season runs, even though they collected them January 1, even though they collected January 1, the season runs from February through May, and it's 4 months paid in advance. So the revenue would be earned at a rate of $15,000 per month, and there's 1 month, and therefore, as you said, multiply it by 1, and you get $15,000. So it was originally recorded as a liability unearned revenue. So you'd have to debit the unearned revenue and credit the subscription revenue. So in this case, you have a liability first, and that would be then reduced and the revenues earned for that period. All right, so you reduce the liability down and you bring up the revenue. All right, so is there anything else on module 5, on deferred revenues? Okay, so then let's do this. Let me move into the next one. Let's go to 6. And 6, we're now going to look at the accruals. We'll do them all together. And in this case, all right, so we're still doing the adjusting entries. We're still on step number 5. But now we're going to deal with accruals. And regarding accruals, this is where an economic event occurs before the cash event, so that revenues are earned, unrecorded, and not recognized at the end of the accounting period. So therefore, you either have an expense or revenue that has not been recognized that has to be accrued at the end of that period, and therefore you will either have a receivable and revenue or an expense and a payable. So once again, remember, one balance sheet, one income statement account, no cash. So let's take a look at some examples. So you could have either, same reasons, rent that's accrued, commissions that have been accrued but unpaid, interest that's accrued. And in this case, an asset revenue relationship exists. There's no cash in advance, so that revenues earned first to make the adjustment, you record a receivable, no cash flow, and you record revenue recognized. Still no cash flow. Only in the future, when the cash is collected, is the receivable paid down. So let's take a look at an example. So let's assume that you have Dolly Engineering performing $15,000 of services for clients, will not pay until November. And on October 31st, we made the following adjusted entry. Notice that there's nothing recorded previously, so you have no previous recording, so you have nothing to actually adjust as you did in the deferrals case. So here, you're going to debit accounts receivable and credit engineering fees earned. Again, one balance sheet, one income statement, no cash flow, and the entry. These are much easier, I think, than deferrals because you don't have to worry about prorating them. So you would debit accounts receivable, except for interest, of course, but accounts receivable, and you credit the engineering fees earned. Questions on the accrued revenue. So an accrued revenue will always be a receivable and revenue. It's either accounts receivable, credit fees earned. It could be interest receivable, credit interest income. Right? So always a receivable and a revenue. Questions on accrued revenues. So again, notice the difference. You don't have to look at an account. There's nothing recorded. You never recorded this before. So you don't have to adjust anything, and I think it makes it a little bit easier. All right, accrued expenses. In this case, same reasons. Could have wages accrued, whatever it is. You've got an expense incurred before you actually record them. So you find out that you get a cell bill from your phone, smartphone bill, internet bill, cable, television, satellite, whatever it is. The bill comes in and then you realize you got an expense, was not recorded before, so you have to debit an expense and you're going to credit a liability. There's no cash flow. Cash flow takes place later when you pay the liability. So you've got expense and a liability, and relatively simple compared to a deferral. So in this case, let's take a look at E as an example. You got Higgins Company accrues salaries. So you got, by the way, the only problem here is, and some of you did ask some questions on Class Pulse or ask my professor, when you got a prorate salaries, you do get some difficulty with the dates. You have to know when the year end is and how many days are in the year that you're accounting for. But in this case, we give it to you, so 30,000 have been accrued, and you just debit salary expense and credit salary payable. The, again, nothing to adjust. Nothing's on the books, and therefore, we've got a simple case of debiting expense and crediting liability. The only thing that would be problematic here, as I said, is if you had to prorate the number of days in the accounting period to find out the salary rate per day plus how many days are actually accrued in that period. All right, so let's take a look at some questions. And once again, we'll go to the back. And by the way, this is a good summary for you, so you can study this. I always put this last so that you have a chance to use this as a guide. It should help you pull this all together if you're having any trouble. All right, so in this one, yeah.
You said it's not reported, just
Yeah, there's no existing balance. Whatever.
so when the person says, you adjusted it, it assumes it needs to be.
Adjusted, yeah. Yeah. So if you're asked for an adjusting entry, it presumes the account is not up to date. Or at least, see, in this case, when I mean nothing to adjust, maybe, for instance, maybe that receivable did not exist. Let's say this, or payable. Let's say there were no salaries payable before. That account didn't exist, had to be created. What I mean by an existing account, unearned revenue or prepaid insurance is there, and you have to adjust it, just like we did with those two examples we just did earlier in the other module, where you've got, well, how much is earned, how much is unearned. In this case, I just know what's expensed and what's earned. I don't have to worry about the unearned portion or the unexpired portion. A is B, true is false, and but everyone didn't get fooled by the wording, which is fabulous. So it is false, that's the correct answer. The accrued expenses are paid after they're incurred. So that's a clean. All right, so now let's do number one on the multiple choice. And it's very similar to CPA exam questions, and I'm giving you the 2 minutes that they expect you to do them in. So this is on a interest on a note. I'm going to bring that up to 2 minutes. All right. So the answer I get is C, but let's ask. So let me see. Winston? Yeah. How do we? Yeah.
So I first
got
got
C.
how much interest we actually owe, so $100,000 times 0.09, so that comes out to $9,000,
Right.
and then I just divide that by 12, so that's $750 per month, and then times that by two months basically, and then I got $1,500.
Exactly. Okay. All right. So let's. Yeah. So C is the answer. And well, while I have you, journal entry. What will be the entry for this one? It's 1,500. So.
So I guess interest expense was 600, interest payable was.
Exactly. Yeah, so the adjusting entry here would be interest expense, 1,005, and interest payable, 1,005. All right, great, thank you. That was good. So that is right. So the answer is C, and I will get this up on the screen for you, so you can see that. And so as Winston mentioned, I'm going to get the numbers on the screen so you can see them. You had a $100,000 note. It's 1 year, that's why I put that in there. 9%, $9,000 per year over a 12-month period is $750 every month. The note accrues interest from November 1 to the year end. 2 months times $750 is $1,500. So it's perfect. And we did get the majority of the class getting that correct. And the journal entry would be to debit the interest expense and credit the interest paid. Any questions on that? It's an accrued expense. Accrued expense. And while I have you on the screen, anyone else, before I move this, anyone else will copy this down? I'm just going to tell you that the next one, make it smaller. If you let me focus this a little bit better. There we go. All right, so if the company fails to make that accrual, this time it's 2,000, it's an overstatement of income because you understated expenses. All right, so if you don't make this adjustment, in this case it's for 2,000. You understate expenses, so you overstate net income. Income's too high because your expenses are too low. Assets have nothing to do with this. Liabilities are not overstated, they're understated by not making that adjustment, right? And understating stockholders' equity will know because you have an understatement of expenses, you overstate income, make that clear, overstate income, and you also overstate stockholders' equity, because don't forget, and I know we're probably not going to see this directly very often, but you know that if you have contributed capital plus retained earnings and expenses from the income statement would reduce retained earnings, okay, of course here you have a liability, so if you don't record it, you understate liabilities. That's, first of all, assets have no effect. So if you use an accounting equation to analyze this, it could help. Assets have no effect. Liabilities are not overstated, they're understated if you don't record this, correct? And stockholders' equities overstated because by not recording this, you fail to reduce the stockholders' equity. So the answer to that one would be A. Income is overstated. All right, so now, after the adjustments are made, we're now going to move into steps 6 and 7. We're going to prepare the adjusted trial balance, and then from the adjusted trial balance, you prepare the financial statements. So, let's take another example. And remember, after all of the adjusting journal entries are journalized and posted, we then prepare an adjusted trial balance to be sure that debits are equal to credits. Again, we don't prove the accuracy. So let's start with an unadjusted trial balance. And the unadjusted trial balance that you see here is at December 31st of this year, 2018. And the balances you have, these are unadjusted. Got cash, $16,800, prepaid insurance, $3,005, accounts payable, $3,000, unearned revenue at $42,000, common stock at $13,000, dividends were declared and probably paid here at, we don't know, but probably paid because I don't see a dividends payable, $4,500, sales revenue would be $25,600, and then we've got salaries of $18,600 and rent of $2,400. The following information is going to be given to us because we're going to practice one last time for the adjusting entries. So it tells us that, number one, the company provided services of $1,000 for customers who paid in advance. So what I know is that of the $4,200, now remember these are unearned, right? So right here, this unearned revenue is $4,200. Now they're telling me of that amount, we provided the services equal to 1,000. So that's the connection. So that I've got unearned revenue of 42, and I've got the 1,000 of that is earned. So we have to make an adjusting entry. Now, this is originally recorded as a liability, so we're okay. Another thing to notice is that retained earnings doesn't show up here because it assumes it's the first year of operation, so there's no retained earnings. Okay, now we've got salaries. And it tells you the company has weekly salaries for a 5-day work week of $350. So that means that they are paying the salaries on Friday, 5-day week, $350. Company's notified that the checking account will be paying interest. I want you to note there was a typo in there. If you have 700, that means we didn't get the correction in time. There should be $70 of interest. So if you have the notes, it should be $70. And that's an accrued revenue. And then the utility bill of $1,200 is an accrued expense. Let's just make sure you make that correction. That should be 7. All right. One last deferred expense. Company bought a prepaid insurance policy of $3,500, and that was on January 1. Now that $3,500, if it's prepaid, how is it originally recorded? Well, I've got to look on the balance or the trial balance, and if I look on the trial balance, I'm going to see that the prepaid insurance is on the books as an asset. So it's originally recorded as an asset. So I have to make an adjustment for that as well. All right, so that's the data that will be used for this purpose. So the first one, we gave you the number. So all you need to do here is to debit the unearned revenue and credit the service revenue. Now the reason why you know what that entry should be is because you looked on the unadjusted trial balance and there was the unearned revenue. So you know it was recorded as unearned first. That is a deferred revenue. Expense. This is an accrued expense. So for $350 for a 5-day work week, they're paying $70 a day. It told you in the narrative that the company has a year end of December 31st, which is a Wednesday. So there were 3 days that were accrued, Monday, Tuesday, and Wednesday. So you have to debit the salary expense and credit the salary payable for the 3 days. And as I said, that's probably, that and the interest is probably the extent of the difficulty with accruals, because you don't have any accounts that were previously recorded. The interest, again, as I said, is 70, not 700. Gave you the number, you just debit the interest receivable, credit the interest revenue for 70. Utilities were given, so you debit utility expense, credit utility payable for 12. And then finally the insurance, this takes a little bit of adjustment because it's a deferred expense. They prepaid $3,500 on January 1, but it's a 14-month policy. So the policy is charged at $250 per month, and therefore from January 1, when it was prepaid, to December 31st is a 12-month period, so you got $3,000. So you have to debit the insurance expense and credit the prepaid. So just to review, we've got a couple of deferrals in there, a couple of accruals. That takes us through, I guess, almost all the possibilities. So any questions on any of those before we take a look at what happens with that information? So you've got those journal entries that have to be made. Okay, so any questions on any of the adjustments? All right. Now, the T accounts, for example, here, the cash account was given to you already, but other accounts had to be created in the adjustment process. So journal entry number 3, this is good to study from because you can see the posting. Journal entry number 3 would debit the interest receivable. Prepaid insurance. The original balance was up here at 35, but then when you made your adjustment, it's for 3,000. Now, there's another typo in here someplace, I'll catch up to that with you in a second. But what I want to show you again is the idea that 12 months of earned, it was $250 a month, if you remember. So that prepaid was $250 a month, so it was $3,500, 14 months. So it's $250 per month. And 12 months were expired, and that would be 3,000. And 2 months unexpired. Or an asset, 500. So make sure the balance makes sense. And in that case, it's 500. Accounts payable, the balance was given to us at 3,000. So we have that already. Utilities payable was created in the adjustment process, 1,200. Salary payable was created in the adjustment process, 210. Unearned revenue. So we said it started, and we don't have any rate of earning, I should say, or any rate by which this is earned. But they gave us the number 4,200, and they said that we earned 1,000. I don't know how you earned that. I don't know what you did. Maybe you delivered inventory. It didn't say something like a subscription or insurance. So you just have to take the number, and the balance is 32. Common stock, that was a beginning balance. Nothing happened there. There was no change. The dividends were given to us. Again, no change. And service revenue, well, it started with 25,600, but you just had the unearned revenue earned at the rate of 1,000. So the revenue is now 26,600. And what I'm highlighting in green, were just to remind you, is just to remind you that you've got those balances given at the adjusted trial balance. And we can do that. So all right. And then interest revenue opened up at 70. Salaries expense. Well, now you have to keep track of this because it started at 18,600 and you accrued. Just want to make this green if I can. So you have 18,810, and then rent expense. That's a balance that was there. That doesn't change. So that'll be a given balance. I'll put that in green. And then finally, utilities and insurance were opened up as part of the adjustment process. So after the adjusting entries are posted, and the insurance, I want you to note, is 3,000, not 5,000. So if you have 5, I don't know if you have the corrected version, but this should be 3,000. Should be. Now, once the accounts have been adjusted, then you prepare the adjusted trial balance. And the adjusted trial balance takes all the balances you just saw on those T accounts and moves them into the adjusted trial balance. Notice retained earnings are still not here yet because we have not made any closing entries. And once again, all you know from an adjusted trial balance is that debits are equal to credits. You're not sure that the numbers are correct. The main point of this module, however, is not only to review the adjusting entries as well as to show you the adjusted trial balance, but now you will be able to prepare the financial statements directly from the adjusted trial balance. We're only gonna do a balance sheet and income statement. Stockholders' equity, I'm gonna give you a detailed section there, so you're not gonna have a separate statement. And we're not gonna do a cash flow statement until chapter 5 or chapter 6. So let's just see what the balance sheet would look like. And first of all, what are the balance sheet accounts here? What would be the balance? What goes on? What's going to go on the balance sheet? Anybody? Yep. Yep. And how far down are we going? What's the last? What's the last? Dividends, right? Just to be sure, dividends is the last balance sheet account because they're not expenses. Dividends are not expenses. Just to remind you, they look like expenses, but they're not. So the balance sheet ends right here. Then the income statement comes. So you simply will take the income statement accounts first. You've got to prepare the income statement first, okay? You have to prepare the income statement first because you need the net income to balance the balance sheet. So you have to prepare the income statement first. So in this case, it's a very simple income statement. Once we get into the details of the course, we're going to tell you that this is called a single-step income statement, meaning that everything's done in one step. All the revenues are added together, 26,670. All of the expenses added together, and in one step you subtract them, and you get the net income of 1260. I just want you to notice that the income statement is a flow statement. It's for the year ended. It's over a period of time, not at a point in time. So any questions on the income statement? I know you've seen it before, but just in case. All right. Next, balance sheet. Now, balance sheet's at a point in time. It's a position statement. And we'll talk about the details on why you set the accounts up this way. We're also going to look at IFRS statements as well. IFRS statements are very interesting. The assets are opposite. They put planned assets first, then they follow that by equities, and liabilities fall below the equities, and we'll show you that. But for us, we usually have assets, liabilities, and equity. So we have total assets of 17,370. Liabilities are 7,610. And in stockholders' equity, you had common stock of 13, but notice you had no beginning retained earnings. And what I want you to notice here is that your net income, which is 1260, net income of 1260 is taken directly from the income statement. So if you forgot that, you want to make sure that you remember that the income statement has to be prepared first. And that number is then transferred to the balance sheet. Another, putting something like this together or writing something like this, what I try to do is hit every point I can think of as a review. Deficit and retained earnings. There's a deficit. Dividends are 4,500, income is 1,260. You've got a negative retained earnings. You could have, and someone asked me a question either on Class Pulse or ask my professor, yeah, you can have, normally balances, you would expect retained earnings. What's the normal balance? Credit, right? You expect to have a credit balance normally. In this case, it's a debit balance. So what you have here is a deficit in retained earnings. And that's possible. Now, you might ask, how could you pay dividends if you don't have enough income? Dividends are based on future earnings expectations, so it's perfectly acceptable. Depending on the state of the corporation, you can pay a dividend even though you don't have enough income to do so. So you could drive a deficit. Now, you can't do that forever, but it's possible to have that deficit. All right, so balance sheet now balances, and this is known, by the way, when you move your net income into the balance sheet, that's known as articulation. I don't know if you heard the term before. The way the statements interrelate is known as articulation. They articulate, and that's important for us as well. All right, so that is the step of adjusting the accounts, adjust the trial balance, and then we move to preparing the financial statements. All right, now, on the questions, I'm just going to say a little bit about the next module, because then we have an exit exam to give you on these topics. If you look at number 1, the adjusted trial balance does not prove the accuracy, so that's false. It only tells you, like any other trial balance, that debits equal to credits. So 1 is false. Number 2 is also false, because the adjusted trial balance includes both permanent, which are mostly balance sheet accounts, and temporary accounts as well, which are income statement accounts and dividends. And we've already done this first question in a different module. You know, what errors don't show up on a trial balance, or what would cause the trial balance not to balance? And the answer here is, if you don't post one side of a journal entry, it's not going to balance. And we also told you that the first statement to be prepared is the statement of net income. And although we didn't show you this, the last statement that we're going to prepare is going to be the statement of cash flows. So that takes us through the adjusted trial balance and the financial statements. Okay, I'm just going to say one thing, and then I'm going to ask you to take a look at some additional questions. And finally, what I want to do here is we just tell you that the next steps would be to close the temporary accounts and to prepare, this is module number 8. And we'll pick this up more on Thursday, and we'll end with this, but we can close the temporary accounts and prepare the post-closing trial balance. So one last question before we ask you to take a look at another diagnostic. And that last question, if anyone can help me, is what accounts do we close out? We close out temporary accounts. So what, just to remind, what are the temporaries?
It's revenues, expenses, and
Dividends, yeah, revenues, expenses, and dividends. And the purpose is to move those accounts into retained earnings. So that's what we're going to see. So on Thursday, we're going to take a look at the closing entries and transferring those to retained earnings. And then we'll prepare the last trial balance. And I have one last question for you. What accounts would remain on the post-closing trial balance? Temporary or permanent, or both? Permanent. Only permanent accounts remain. Obviously, if you close the temporaries, they go to 0. And the reason why you do that, by the way, the temporary accounts are like your, as I always say, like your W-2 form that you file with your taxes. You start the year off, you got nothing on there, right? Because every year you start with all revenues start with 0 balance, and your tax expense start with 0 balance. Okay,